morning, and thank you everyone for joining us today. At this time, we want to extend a special thank you to our silver sponsor, Horizons ETFs. To learn more about Horizons investment solutions, please make sure to visit their virtual booth in the exhibit hall. Joining us this morning for our next presentation is Steve Hawkins, the President and CEO of Horizons ETFs, and member of the Mira Asset Global Investment Group, where he is responsible for the day-to-day business affairs of the firm. With more than 30 years of experience in the investment industry, Mr. Hawkins has been with Horizons ETFs for more than 12 years. He is partly responsible for the proliferation of ETFs in Canada, bringing many of the first-kind ETFs to market. Mr. Hawkins spearheaded the launch of the first family of actively managed ETFs in Canada, the world's first marijuana ETF, and the world's first global equity ETF driven by artificial intelligence. As an innovative ETF and capital markets thought leader, he's frequently quoted in the news media, appears regularly on business television, and is globally sought after speaker for his expertise on three favorite topics: ETFs, derivatives, and cannabis. Mr. Hawkins was recognized as CEO of the Year at the 2018 Wealth Professional Awards and is the current chair of the Canadian ETF Association. Steve, thank you so much for joining us today.
Jordan, thank you very much for having us here today.
Excellent. I'm going to stop sharing my screen and ask you to bring up your slides, please.
Is it not sharing that screen?
You're going to go ahead and click the share screen button at the bottom of your Zoom panel.
Okay.
We're all set. The stage is yours to begin the presentation.
Okay. Thank you, Jordan. Thank you, everybody, for being here and attending the Money Show virtual event this year. Obviously, it's a little bit different from past years where we got to see you in person. You got to, feel us and touch us. We got to talk about things firsthand. We got to look at all the wonderful swag that everybody produced every year. And if you hang on to the end of this presentation, we'll try and hook you up with some swag as well. So I want to talk to you all a bit here today about what's gone on in the ETF industry in 2020. Horizons ETFs is an ETF-only producer. We don't manufacture mutual funds or sell mutual funds anywhere in Canada, so we only sell ETFs. And I really wanted to pump up ETFs a little bit more for you in the discussion today and what's going on in the Canadian ETF industry. So really for us, again, ETFs have seen tremendous growth on an overall basis. ETFs are on pace this year to outperform all past years from a growth perspective, both from a value or AUM coming in, as well as on a percentage basis. We're going to talk a little bit about what ETFs people are buying out there, so what sectors, asset classes people are looking into. I want to talk to you about one of my latest favorite subject matters, which is the 60/40 ETF and balanced ETFs. How do they work? We'll talk a little bit about where yield is and some opportunities that you might have if you are looking for yield, and some other things that you should be watching as we sort of enter into Q4 of 2020 and into 2021 from a trends perspective. So I'm going to start it off a little bit more about from a growth perspective. As you can see from this chart, you can see the overall growth, one in the number of ETFs in the black box, the number of sponsors in the blue box, but AUM, this continues to bog our minds every single day. We're looking at the continued growth of the ETF industry. One of the reasons why we only offer ETFs, we still believe on an overall basis that ETFs are the place to be. It is the investment choice for the Canadian investor going forward. It has been for the last few years as ETFs have outsold mutual funds. And here we are, strict demonstration of what is going on from an ETF to mutual fund sales perspective. 2018, we started the strong trend of ETFs officially outpacing mutual funds from a sales perspective. 2019 up to August 31st, we see the majority of that 60% being going into the equity markets, but really the majority of that came into the equity markets after the turmoil of the volatility that we experienced in March of this year. And we've seen a lot of investors that had been sitting on the sideline with a lot of different cash move money into the equity marketplace in Canada. And so we see equities really dominating the overall marketplace from money coming in. We see fixed income as well. I mean, Canadians are the biggest fixed income investors in the world. We continue to be that. We continue to prove that to the world. I'm not sure that it's always the right place to be, but Canadians, generally speaking, have always invested a lot of money in fixed income, and this year is no different from that. We see 35% of the money that's going into the Canadian ETF world going into fixed income. Though this trend has changed from last year, where last year Canadian investors were really like over 50% invested in fixed income and under 50% invested in equity. So this year we have a trend the opposite way, where we're seeing equity dominating fixed income. And obviously there was a lot of uneasiness in the marketplace last year, and we saw that in March this year come to fruition, with COVID really impacting the capital markets place. Interesting points here. Commodities, we've seen the commodity space increase by almost 25, more than 25%, by almost a third, with over 700 million coming into commodities, as gold and oil have been really topical subject matters and investment asset classes that people have been pouring money into. Natural gas as well has been a very strong performer of late, but gold has really been taking the lion's share of people investing into commodities, as really is a safe haven type of investment. One of the things that we're going to talk about a little bit more as I get through this presentation is multi-asset. So we love multi-asset. Multi-asset is really sort of the balanced funds. This is where the majority of money has been invested in the past in the mutual fund landscape. And now there's a lot of different product offerings in Canada in the multi-asset category, which is basically the one ticket do-it-yourselfer type of investment. You can buy it, leave it, forget about it, and it gives you both your equity exposure and your fixed income exposure if you want to, or gives you exposure to a multitude of different equity and asset classes around the world, from a Canadian, US, global perspective. We've also seen a very active investing in leveraged, inverse leveraged products this year, with respect to people trying to take advantage of the significant volatility. So, inverse leveraged products are really people betting on what is going on in the marketplace, and we've seen a significant amount of activity in the inverse and leveraged marketplace. Very, very similar in Canada, or sorry, in the US. I mean, look at commodities. We've seen $44 billion of money being invested into commodities in the US, and the majority of that, again, went into gold, but a lot has gone into crude oil, nat gas, silver. With that volatility, people are playing that space very actively. Currencies have really taken on. We have a small currency ETF marketplace in Canada, but in the US, there's a very, very active currency marketplace. People are betting on the US dollar, or betting on euro or yen versus the US dollar. So there's a lot of actual currency investing as an alternative investment there. On top of commodities, people not investing in the traditional US equities or international equities or fixed income. You got to remember, the US marketplace for ETFs is over 10 times larger than the Canadian ETF marketplace. But we also see, look at inverse ETFs. So in the US, with all of this market volatility, we've seen over $13 billion of money being invested into inverse ETFs, specifically in the US. So really, a lot of this was being invested during the whole COVID market volatility issue back in March, but people hedging their portfolios after that fact. And right now, with all of this uncertainty of what's going on with, potential phase 2, capital markets appreciation, the market's running up so significantly over the summer until the last few weeks, S&P, NASDAQ at all-time highs, people investing as hedges or betting against the market generally itself. Now I'm going to talk to you a little bit about 60/40, sort of one of our new favorite topics. It's been in the news recently. The Globe and Mail, Wealth Professional, Morningstar, they've all done articles on 60/40 of late. Really for us, we believe the traditional 60/40 balanced portfolio is dead. Things have changed with respect to our capital markets. People's time horizon of investing has changed. You need to invest for longer periods of time. So people have to have their money invested for longer periods. They need to earn more return. They're not looking for just riskless yield on a year in, year out basis. They're looking for growth and continued growth, and they need to continue to grow those portfolios so they have greater capital appreciation at the end of the day, when they actually need to withdraw from their savings when they want to retire. The interest rates over the past decade has continued to go down. And when the 60/40 portfolio was originally created, interest rates were significantly higher. Yields were significantly higher. Now people continue to need to appreciate their portfolios, and you're not going to get that out of traditional fixed income anymore. You know, you need to be able to grow your portfolios, and we just don't see the capital growth opportunities in fixed income the same way that it has been in the past, especially with lower rates out there right now. And the strong equity performance, you know, over the past 10 years and even 25 years in certain circumstances, you know, we've seen equity portfolios continue to significantly outperform fixed income. Fixed income is a safe haven. It is a great investment if you don't want to take any market risk at all, but really has the equity has that risk reward profile really paid off for you if you are a big fixed income investor? It has not. And people, again, need money at the end of the day when they want to retire, and where they're going to get that capital appreciation is really from the equity side of the portfolio. So we traditionally don't look at horizons. We launched several multi-asset portfolios, and we looked at the 60/40, and we said the world has changed. We can no longer use the 60/40 portfolio. One of the other big changes that we've made, and I'm going to get into those ETFs very, very shortly, but traditionally, people have always looked at the US equity market as investing in the S&P 500 or investing in the Dow Jones. You know, these indices, although have weightings of some tech stocks and things like that, really don't provide, again, the same growth opportunity that investing in, as an example, the NASDAQ 100. You know, we launched our HXQ ETF, which invests in the NASDAQ 100. It is a very tax-efficient total return portfolio, but we use investing in NASDAQ as one of the asset classes to investing into U.S. equities. Sure, we have our S&P 500 allocation, but we're also investing in the NASDAQ 100 because we want that growth portfolio from the U.S. equity market that people are investing in. And here you can see from this chart what NASDAQ has really done to the Dow Jones as a comparable and to the S&P 500 this year. You know, at the start of the year, you're basically slightly up with respect to the S&P 500. You're slightly down with respect to the investing in the Dow Jones, but the NASDAQ 100 itself is up significantly on a year-to-date basis. And the world is really changing from who is investing and what are they investing into. You know, tech is really leading the charge with respect to innovation, new products, biotechs. You know, people are not, bricks and mortar really hasn't had the same ability to invest in this year because of COVID, you know, and we see this, the world is really going to change the way it looks at bricks and mortar versus online from a here going forward basis. Interest rates, again, as I talked about, near lows on an overall basis, you know, near zero right now, all-time lows over the past 20 years. You know, and this trend is really here to stay from our perspective. We can't really ever foresee interest rates really going above 5% ever again. And so we're stuck in this very, very long-term low interest rate environment, and that really means that you're going to have to be chasing yield someplace else. So getting to our specific TRI balanced portfolios that offer this multi-asset class exposure. So we have three different options for you. We have our HCON ETF, which is the more conservative ETF, and it's a 50-50 allocation over the traditional 40-60 allocation, 40 equities, 60 fixed income. We're 50 equity, 50 fixed income, and that is our conservative type of balanced portfolio. Our balanced portfolio, our truly balanced portfolio, is 70-30 equity versus fixed income. And this is really the direct comparison to the traditional 60-40 way of thinking. And we believed that we needed to under-allocate fixed income and over-allocate equity. You know, we launched these two products back in 2018, well ahead of people even thinking that 60-40 is potentially dead. We've been running these portfolios at 60-40 and 50-50 for the last 2 years. We really had to look at these from a forward-thinking perspective and what people are going to be investing in the years to come from that perspective. And then we have HGROW, which is our recent addition to this product. It's only a year old, just had its 1-year anniversary basically. But people have been looking at growth balanced portfolios or growth multi-asset portfolios for exposure to Canadian equities, US equities, global equities. But there's always the traditional way of looking at a growth portfolio is 80-20. we looked at it as like if people want equity growth in their portfolios and they want to invest in a global equity balanced portfolio, why do they want fixed income in it? So we launched HGROW 100% equity. We've got a Canadian allocation in there. We've got an S&P 500 allocation in there. We've got a NASDAQ 100 allocation in there. We got MSCI ETH allocation in there. So we got, again, your global exposure, but we put it all into one bucket and it's 100% exposed to equity. These are our three main offerings that we offer out there with respect to multi-asset. The really nice thing about these portfolios as well is they only own our tax efficient ETFs underneath inside these portfolios. So we use asset allocation. We're only charging the fees of those underlying ETFs as they flow through in them. We have no top line management fee for any of these products because we earn our fees from the underlying asset, the underlying ETF that these own in them. But our ETFs that we own in them don't make distributions. So we're giving you access to these beautiful asset class balanced portfolio TR one ticket solutions, and we're not giving you distributions out of these unless you want to. So we can figure out a way that you can sell down if you want a distribution, but these portfolios are built to be tax efficient and not provide distributions to you. HCON itself, again, 50-50 from an equity fixed income perspective, from an international exposure, 45, 41, and 14. Obviously, there's a lot of Canadian exposure in there, both from a Canadian and from an equity and fixed income perspective, but US, again, a very, very significant weighting because the world is weighted to the US over Canada, over international. So we have a very significant US weighting in there. HBAL, our favorite 70-30 portfolio, outpacing the 60-40 portfolios that you've seen. Again, a very, very high exposure to the US from both equity and fixed income, some international exposure, and a very small Canadian overall exposure. Canadians on a whole as investors are overexposed to Canada. These portfolios are giving you that global diversification outside of Canada. And then HGROW, our baby from a growth perspective. Look at this high weighting to US, includes S&P 500, includes NASDAQ 100 in there, a very small allocation to Canadian equities as well, and then a much larger allocation to the world from a global markets perspective. Just to highlight the performance of these products on a relative basis, you know, our HBAL, our 50-50 portfolio, significantly outperforming all of the other balanced portfolios in there on a year-to-date basis, on a one-year basis, on a two-year basis. HCON, again, our conservative portfolio at 70-30, outpacing those other sort of, HBAL is the 70-30, HCON is the 50-50, but outpacing those other 40-60 portfolios very significantly, again, for all periods of time since it launched. You know, more specifically, you want to pay attention to the 6 month, the year-to-date, the 1 year, the 2 year numbers there. And then HGROW, which is our new baby, which is only 1 year old now, and it has significantly outpaced all those other growth portfolios. You know, we're 100% invested in equities, and most of those other growth portfolios have some asset allocation to fixed income in there, being 80-20 is the traditional norm. Some of the themes that you want to be paying attention to this year: preferred shares. So people have, you know, worried about preferred shares for a long time. It's underperformed pretty significantly in 2019, but there's some things that have changed to the way that the banks are issuing new securities these days. There's these new issuance called an LRCN, limited recourse capital notes. These are very akin to preferred shares. They actually can convert to preferred shares at the end, but the banks have been working on this type of capital market product for a very, very long time. Finally only received approval this year from OSFI and the CRA and the Ministry of Finance to offer these types of products. RBC and National launched products before September, and then since September, we've also seen BMO and CIBC issue their own limited recourse notes. What this means, though, to the preferred share market is that there's going to be less preferred shares. The banks are going to be looking at LCRNs, which are much more capital friendly for them from an ability to issue perspective. And there's going to be less preferred shares. They're going to be able to raise more capital. They're going to be buying back some of those rate reset preferred shares. They're going to be, the universe of preferred shares is going to get smaller. And when that means is that people are going to be paying up for preferred shares, where we've seen preferred shares retrace in prices up to earlier in 2020. Now we're starting to see preferred shares really do well in this marketplace as LCRNs have come into the marketplace itself. In the sort of corporate fixed income world, and prefs have always been a quasi fixed income, but LCRNs are going to be a really good thing for preferred shares on an overall basis. You know, and where can you get yield? So if you're chasing yield, we believe preferred shares is really a great place to go. You know, the yield on preferred shares is taxed as dividends. It is not taxed as income. So it's very tax efficient for you to own preferred shares on a relative basis to other fixed income securities, which are paying income out to you and taxed at a higher rate. But look at sort of the pre-tax yields on S&P TSX preferred share is almost 6%. And then on an after-tax advantage basis, because it's not income, it's over 7%. You know, you're not getting anything even close to 1% on your money sitting in the bank account at a bank, but you can own bank securities and you can earn almost 7% on an after-tax basis by owning preferred shares out there. Some other things that you might want to be thinking about. Marijuana, it's always a topic. People are talking about marijuana all the day. You can see from my marijuana friend behind me here, something that is always on our mind here. You know, we did launch the world's first marijuana ETF. But we have seen through COVID specifically, marijuana sales in the US really significantly increase. And look at California as an example on the left side of the chart here. I mean, California itself has on a monthly basis over 300 million US in monthly sales. You know, that is significantly more than all of Canada's cannabis sales, even though Canada's cannabis sales in Canada have continued to significantly increase. Colorado has stayed pretty stagnant. You know, still very, very positive, is one of the very first states that legalized. Nevada stayed pretty well, but Oregon continued to grow significantly from a sales perspective, and even Washington State, we've seen. So these are the biggest users of cannabis right now from a legalized state perspective, and we see continued excess growth in marijuana sales so far in 2020. You know, again, marijuana from a legalization perspective, we don't know what's going to happen in this election. You know, we know what Biden is saying, you know, with respect to potential legalization. We know what Trump is saying with respect to, I don't really care about marijuana. But, you know, there's only a few states left where it is fully still illegal to buy marijuana. It's pretty much available anywhere you go in the US, except for the extremely conservative states that are out there. And this chart still changes every year. I mean, recently this year we had Illinois where marijuana became legalized. So US marijuana sales, which is again going to be the biggest marijuana market in the world, continues to legalize, continues to grow, and we really see globalization of marijuana through legalization. For us, you know, here in Canada, looking at us directly, Canadian marijuana sales continue to grow. You know, this year we've seen some nice growth on an overall basis. We're still looking for that sort of overall annual $2 billion in sales mark, but we believe that we're on pace for that now, and we're going to meet those targets over the next 12 months from here going forward. But, you know, Canadian LPs still have great access to the equity markets. There hasn't been a lot going on overall in the capital markets, but Canadian LPs have really been able to come back to the equity markets of late. We've seen lots of US companies come to the Canadian equity market to do their offerings. So we offer two very, very specific ETFs to provide you exposure to marijuana. One is HMMJ, which again is the world's first marijuana ETF. This is the largest marijuana ETF in Canada. It's the second largest ETF and marijuana-based ETF in the world. Provides you access to all of the big Canadian marijuana companies and those operating legal marijuana related businesses in the world, like Innovative Industrial Properties provides marijuana infrastructure to grow-ops. Scott's Miracle-Gro, you all know, but they're not just about lawn fertilizer. They are very heavily into hydroponics and supporting the marijuana industry. Charlotte's Web, which has been a favorite kind of you know, CBD producer in the US, really is a big hemp producer, but it's operating a completely legal U.S. operating business. It's a big part of our portfolio. And then you got the usuals that you see very rarely, very referred to in the news here: the Canopies, the Auroras, the Afrias, the Cronoses, the Tilrays. These are the darlings of the Canadian marijuana space. Our newest offering, which we launched more than a year ago, almost 2 years ago now, is our U.S. Marijuana Index ETF. This only invests in marijuana, U.S. marijuana companies. We really see significant growth opportunities in the U.S. marijuana space. It really is operating in all of these fully integrated producers in the U.S., which really are state-held and owned and operated in specific states, but they have great growth opportunity in the U.S. marijuana marketplace. And we've seen from the charts before the different sales. Some of the names that you see in there: the Curaleaf, the Cresco, the TerraSend, Acreage, which has done the partnership with Canopy. These are all companies that are doing extremely well in Canada. Curaleaf as its own, from an annual sales perspective, is on pace to significantly outpace Canopy from an overall net revenue perspective. All of these companies, just for your reference, for the most part, all of these U.S. marijuana operators are not listed on the Toronto Stock Exchange in Canada. They're listed on either the Canadian Stock Exchange here or the NEO Exchange here. The NEO is one of the other big board exchanges here in Canada. And HMUS, our U.S. marijuana ETF, is also listed only on the NEO Exchange because it owns these companies that could be technically believed to be operating illegal businesses under federal marijuana rules in the U.S. So we don't have the ability to list HMUS on the TSS as an example, where HMMJ is listed. And just so you see the performance differences between sort of the Canadian ETF marketplace and the Canadian marijuana ETF marketplace and the U.S. marijuana, on a year-to-date basis, U.S. marijuana is basically flat. Canadian marijuana is down roughly 18%, but on a one-year basis, we see a significant outperformance of U.S. marijuana companies relative to Canadian marijuana companies. We still believe wholeheartedly in the marijuana market itself as a whole, but right now we believe there is significantly more opportunity with U.S. marijuana, especially with this upcoming election and the potential for legalization of marijuana as a whole in the U.S. And really, that is my entire presentation today. I know I jam-packed a lot of things in here. We're going to take on some questions in a minute, but one of the things that I wanted to highlight to everybody here today is that I know you guys are missing being at the Money Show in person. You get to come to the booth, you get to pick up our swag, you get to talk to people. So this presentation is going to be available to you on our website. It's also going to be available in the Money Show virtual booth. If you come to our website or the virtual booth and download this presentation, if you send us an email, info@horizonsetf.com, we will send you one of these very, very pretty Horizons ETFs fidget spinners. I can tell you this occupies so much of my time during the day as I'm working because it just does not stop spinning. So if you want access to a Horizons ETF fidget spinner, please come to our website or go to our virtual booth, download this presentation, and then send us a little email. This is our give back to you for attending here today and for attending the Money Show generally. And we're very, very sorry that we can't do this in person with you, but we're really looking forward to 2021. We can come back to doing this again in person and having some fun and talking to you directly. That's my presentation today. Jordan, I only have a couple minutes left, but do you have any questions that you want to put to me?
Absolutely, and we want to thank Horizons and Steve for an excellent presentation, and we definitely miss having you guys and every one of our attendees in person, and we're very excited to welcome everyone back in 2021 to the Toronto Money Show, and thank you, Steve. And just as a friendly reminder, from what Steve said, the session slides are available in the Horizons virtual booth. You can actually scroll down on this page and you'll see 2020, a record-breaking year for ETFs by Steve Hawkins, and you can go ahead and download that right to your virtual briefcase. And then you can also request more information on the right-hand column. Steve, what was the email address again if they want to reach direct out for the fidget spinner?
info@horizonsetfs.com.
Excellent. We've got time for just two quick questions, Steve, if you've got a moment.
Sure, that's great.
Excellent. So our first question is, do any other providers offer swap-based ETFs?
So presently in Canada, there are no other ETF providers that are doing a total return synthetic ETF strategy. But very, very recently, BlackRock, the largest asset manager in the world, has announced that they and they just launched their version of an S&P 500 ETF, which looks identical to our HXS, our S&P 500 ETF here. They've launched a total return synthetic ETF, UCIT ETF in Europe. They can't offer that product in the US. But our total return ETFs have really outsold all physical replication ETFs on a broad-based index this year in Canada, and we believe that this is a great turn of events for us, and really supports the strategy that we've been running for over 10 years here now, with BlackRock, the largest asset manager in the world, launching their own similar product in Europe.
Excellent. Our next question is, do you anticipate that NASDAQ will continue to have more prevalence as a US benchmark?
We love the NASDAQ. We have been investing in it for quite a while. We've been over allocating on a relative basis compared to most of our competitors who stick to sort of the more total return or broad-based of US equities. We believe that investing in the NASDAQ is investing in the future. And right now is, this COVID, I think, has brought the future of people and the way that they work and interact forward so much quicker than everybody anticipated. And the work from home atmosphere, the Zoom calls, the GoToMeeting calls, everything being done virtual like this Money Show, this is a trend that is not going to go away very quickly. People, will they have to come to the office to work anymore? There's going to be so many things. The tech world has been developing for so long. It's being put into place now, and the NASDAQ itself is the broad-based U.S. equity index that is really going to see the returns come through from technological advancement that we've seen just here in this past 6 months.
Excellent. Well, Steve, that's all the time we have for today. It's an absolute pleasure having you join us. I believe Horizons will also be speaking at the next Money Show virtual event in November. So for the audience that would like to join another session as well, they can come back in November. As well as Horizons has a panel tomorrow as well with Mark Noble, and they'll have an opportunity to hear a discussion on the 60/40 portfolio, which Steve briefly touched on in today's presentation. Also want to remind the audience, just to reiterate, that you can download Horizons session by visiting the virtual booth, which you are on right now. You can see it in the download section, 2020, a record-breaking year for ETFs by Steve Hawkins. And you also, if you would like access to the fidget spinner as well, you can do so by requesting more information on the right-hand column of the page. Steve, thank you for being such a valued partner. We always love having Horizons join us, and want to thank you for your time today.
Jordan, thank you very much for having us at the Money Show. We're going to be here next year.
Absolutely. Stay safe, and we'll talk soon, Steve.
Okay. Bye-bye.
Bye-bye.